So let welcome to all of you Shiksha 360. And today basically we have to discuss chapter number 15 part 2, that is ratios part 2. Clear? So let's start our discussion. In the previous session, basically what we have discussed regarding the current ratio, liquidity ratio, and stock turnover ratio. Clear? And stock turnover ratio. Clear? These three ratios basically we have discussed in the previous session. Clear? So now first of all, this is basically part 2. In this session, first of all, basically I want to discuss some of the questions basically with all of you, so that you are able to understand clear what type of question basically will they ask in the examination. Clear? Basically what type of question will they ask in the examination. Clear? So the first question basically presents on your screens now. Clear? The first question is present on your screens now. Let's start our discussion. So here basically we have to find that the current ratio. Clear? So current ratio basically is equal to what? Current asset upon current liability. Clear? Current ratio, it is equal to what? Current asset upon current liability. Clear? So here basically we have given different things. Clear? So basically we have to find that what is comes under the current asset. So what is to be comes under the current asset? So current asset, inventories basically we can say that basically it is like a stock. Inventories basically, like we can say that basically it is a type of the stock. Clear? So basically it is included under the current asset or the current liability. Please tell fast. Inventory basically where it will included? It will included under the current asset or the current liability. Basically it will included under the current asset. So trade receivables, please respond fast. Trade receivable, that is basically we have supplied anything to anyone. Basically we have supplied our products to any party. Clear? Now basically trade receivables. Clear? Basically we have to receive the money from them. That is like, we can say that like debtors. Clear? Like debtors. So it is also one of the current assets. Advanced tax. Clear? Basically what we have to pay in the upcoming time. Clear? We have already paid. Clear? Basically we have already paid. Clear? So basically it is also comes under the asset. Clear? Cash and cash equivalents. Clear? Cash and cash equivalents. Whether it is current asset or liability, basically this is also current asset. Trade payables. Clear? That is basically we are buying material, raw material from any firm, and we have to pay money to them. Clear? Basically we have to pay money to them. That is trade payables. Clear? That is basically liability. That is current liability, CL. Short-term borrowings, that is basically we can say that like loan or bank overdraft. This is also current liability. So current asset upon current liability. Current ratio is equal to current asset upon current liability. What are current assets? Inventories, 50,000. Plus trade receivables, 50,000. Plus advanced tax, 4,000. Plus cash and cash equivalents, 30,000. Upon trade payables, 1 lakh. Upon short-term borrowings, that is 4,000. So 1,34,000. It is our current assets. Current liability, that is 1,04,000. So 134 upon 104. 67 upon 52. So please tell fast what is the answer. What is the current ratio? Current ratio. What is the answer of the current ratio? So it comes out to basically 1.288 upon 1. Or in simple language, we can say that basically 1.29 upon 1. Clear? So this is the current ratio. Clear? So this is the current ratio. Please tell fast. If anyone has any doubt, any query regarding that, please respond fast. If anyone has any doubt, any query regarding that. Otherwise, basically, we will move to the next question. Now move to the next question, liquidity ratio. Clear? In the previous session, basically, we have discussed also regarding the liquidity ratio. liquidity ratio, or we can say that quick ratio. Yes, quick ratio, clear. Quick ratio, that is current assets upon current liability, clear. Quick ratio quick asset upon current liabilities, clear. Quick asset upon current liabilities, clear. So now let's here discuss, clear, like in the previous question. Advanced exit is basically current asset, clear. It is current asset that basically we have already paid, clear, that we have already paid. So now here current liabilities basically they have given. So quick ratio is equal to quick asset upon current liabilities. Quick asset basically, how we can say, current liabilities, that is 50,000, clear. So denominator here it is to be fixed. Current asset minus what we have to subtract from here, clear. Basically what we have to subtract, this is we have utilized. So current asset 80,000 minus inventories, that is basically stock. Stock basically we have to subtract from that or not? Stock basically we have to subtract from that, clear. Stock basically we have to subtract from that 20,000. Advanced exit is subtracted or not? No, it is not any role, clear. So prepaid expenses, because it is converted into the service. It is converted into the service. So basically we will subtract that also upon 50,000. 55,000 upon 50,000. 11 upon 10. 1.1, clear. 11 upon 10 or 1.1, clear. So what is the liquidity ratio, clear? So sorry, what is the quick ratio? It is to basically 1.1, clear. So quick ratio here it is to basically 1.1. Any doubt, any query regarding that? Please respond fast if you have any doubt, any query regarding the quick ratio. Clear. So in the examination, basically if they are asking the liquidity ratio or the quick ratio, clear. So this is to be same here. And please remember that quick ratio basically it is equal to the quick assets upon current liabilities, clear. Quick assets upon current liabilities. Please remember that. Now move to the next one. Last question. This question I have already discussed yesterday in the group also, but some students even after has doubt. So I will discuss once again here, clear. So I will discuss that question once again here so that all of you are able to understand that question properly. So now what is the question here? Net working capital of a firm is 80, clear. Net working capital of a firm is 80 and its current ratio is 1.5:1. What are its current liabilities and assets? Clear. What are its current liabilities and assets? So net working capital. Current assets minus current liabilities. 80 is equal to current asset minus current liability. So please remember this is one of the equation. Current ratio is equal to current asset upon current liability. That is 1.5/1. So current asset here is equal to 1.5 current liability. Just substitute it here. So current liability here it is to be 160. Clear. Current liability here is to be 160. And what is the current asset? 80 is equal to CA minus 160. So current asset is equal to 80 plus 160 is equal to 240. Clear. So current asset here is this to be 240 Current liability, clear? First, what they are asking, current liability. Many of you are option even take C, that is 240, but here 320. Sometimes they are given here 160, clear? So it is little bit confusing, clear? So what will be the answer, clear? So please remember that it's current liability, that is 160. Current asset, that is 240, clear? Current asset, what is current asset and what is current liability? So please tell fast, even if you have any doubt, any query up to this much point, clear? Please tell fast, please respond fast if you have any doubt, any query up to this much point. Hope it is clear to all of you regarding the current assets, current liabilities, and what is the net working capital. Clear? Definitely you will get 1 or 2 questions basically from these things, clear? We'll discuss more question in the upcoming days, clear? Basically, just please remember the concept, clear? I will say again to all of you, try to understand the concept. Questions are never be typical, clear? If you are able to understand the concept properly, clear? Now move to the next concept, clear? Now move to the next concept. Debtors turnover ratio, clear? Now debtors turnover ratio, clear? So what is the meaning of the debtor turnover ratio, clear? So let's discuss. So debtors basically, that is basically whom, basically from whom basically we have to receive the money. Debtors basically from whom clear? Debtors basically, what is debtors basically from whom basically we have to receive the money. So debtors here basically, debtors are an important constituent, clear? Debtors are an important constituent of current assets, clear? Basically debtors are an important constituent of current assets, and therefore the quality of debtors to a great extent determines a firm's liquidity, clear? So therefore the quality of debtors to a great extent, clear, basically determines a firm's liquidity, clear? So basically 2 ratios are used by the financial analysis basically to judge this, clear? Like basically we have to receive the money, clear? Sometimes basically we will receive the money on time, and sometimes basically the other person basically will continuously delay. Like all of you are working in the banking sector, clear? So some persons paying the installment, clear? Some person basically paying the installments basically when they are to be due. Clear? Some person basically paying the installments basically when they are to be due, clear? And next one, some are paying the installments when the account basically comes under the SMA category, that is special mention account category. Even some, there are also persons when they are pay the installment basically on the last day, like on the 90th day, because the next day basically account goes to be empty. So please tell fast. I think all of you have seen these 3 types of the customers. Please tell fast. I think all of you have seen basically these 3 types of the customers, clear? So basically for the bank, all these 3 are the debtors. Clear? Basically for the bank, basically all these 3 are the debtors, clear? Just to understand the meaning of that, clear? So here first one, that is debtors turnover ratio. Second one is basically debtors collection period, clear? Debtors collection period, clear? So what is debtors turnover ratio? So debtors basically from whom basically we have to receive the money, clear? Basically for what basically we have to receive the money? That is basically we have sell something to them. That is basically we have to sell something to them. Only on the behalf of that basically we are receiving the money. So debtors is basically, it is related to the credit sales, clear? That is basically we have sold something to them. For that basically we are receiving the, basically we want to get back the money, clear? So what is that basically? That is debtors, clear? That is debtors basically, that is related to the credit sales, clear? Debtors basically it is related to the credit sales. Turnover. Turnover, what is the meaning of turnover? Turnover, that is basically annually basically how much you have sale, clear? Basically annually basically how much you have sale, that is basically known as the turnover. So that is basically average accounts receivable, clear? Average account receivable, that is basically turnover, clear? So debtors turnover ratio, clear? Just basically from the word debtors, that is credit sales. Turnover, that is average account receivable, clear? That is average account receivable, clear? So credit sales upon average account receivables, clear? That is debtors turnover ratio, clear? That is debtors turnover ratio. So the term accounts receivable, clear? Basically, the term accounts receivable, basically it includes trade debtors and bills receivables. Clear? The terms accounts receivable, clear? Sometimes basically they have given the data and we have to identify, clear, basically which we have to include under that or not. So please remember that these are the specific terms given in the book. So that definitely they will ask question basically from these things, clear? So that the terms account receivable, basically it includes trade debtors plus bills receivables, clear? So it includes basically trade debtors plus bills receivables. In case details regarding opening and closing receivables, clear? That is basically at the starting and at the end, clear? In case details regarding opening and closing receivables and credit sales are not available, clear? Sometimes basically we can say that details regarding opening and closing receivables and credit sales are not receivable, clear? Like average, basically we can calculate opening stock plus closing stock, clear? So in this way, basically we have to calculate the average, clear? So if these details basically we have not available in our hands, clear? So in case basically details regarding opening and closing receivables and credit sales basically are not available, so the ratio may be calculated as follows, clear? So in that case, basically how the ratio basically will be calculated? It is equal to the total sales upon account receivables, clear? So in that case, the ratio basically may be calculated as follows, that is total sales upon accounts receivables, clear? That is total sales upon accounts receivables, clear? This is the formula, clear? In the different case, clear? Basically when we have not sufficient information regarding that thing. Okay, so please remember that both these formulas, clear? Please remember both these formulas that are very, very important for the examination point of view. Now move to the next one, clear? Now move to the next one. Please tell fast if you have any doubt, any query regarding that. Okay. So what is the significance? Clear? What is the significance? Sales to accountable accounts receivable ratio, clear? That is debtors turnover ratio. So sales to accounts receivable ratio, basically it indicates the efficiency of the staff, clear? Basically it indicates the efficiency of the staff entrusted basically with the collection of book debts, clear? That is basically we are book debt, that is basically which money, that the money basically which we have to receive from the market, clear? That is book debts, clear? So basically it indicates the efficiency of the staff entrusted basically with the collection of the book debts. The higher the ratio, if the ratio is higher, the better it is, clear? The higher the ratio, the better it is, since it would indicate that the debtors are being collected more promptly, clear? The higher the ratio, the better it is, since it would indicate that the debtors are being collected more promptly. For measuring the efficiency, clear? Basically for measuring the efficiency, it is necessary to set up a standard figure, clear? Basically for measuring the efficiency, basically it is necessary to set up a standard figure, clear? That is this much is the standard ratio. A ratio that is lower than the standard basically will indicate inefficiency, clear? That is, if the ratio basically it goes basically from that level, it indicates that it will inefficient, clear? That is, their efficiency is not up to the mark. So this ratio basically helps in cash budgeting, clear? Because we know that if our ratio is good, so we know that basically we are receiving the money on time, clear? Or basically we can say that basically our business is going good, clear? And if basically it is less, so basically we can say that basically there is some issue at any point, clear? So the ratio basically helps in cash budgeting, since the flow of cash from the customers, clear? The ratio basically helps in the cash budgeting, since the flow of cash basically from the customers can be worked out on the basis of sales, clear? The ratio helps in cash budgeting, since the flow of cash basically from the customers can be worked out, clear? Basically can be worked out on the basis of sales, clear? Can be worked out on the basis of sales, clear? So that is regarding the debtors turnover ratio, clear? That is regarding the debtors turnover ratio, clear? Now move to the next, debt collection period ratio, clear? Now here, that is basically we have to move to the next word, that is debt collection period ratio, clear? That is basically within how many days, clear? Basically we are receiving our debt, clear? That is basically we are receiving the payment. That is basically debt collection period ratio. So the ratio basically indicates the extent to which the debts have been collected in time, clear? So the ratio basically indicates the extent to which the debts have been collected in time. it gives the average debt collection period. Clear? So what it gives, basically it gives the average debt collection period. So the ratio is very helpful. The ratio is very helpful to the lenders because it explains to them whether their borrowers are collecting money basically within a reasonable time. Clear? Clear? Basically the ratio is very helpful to the lenders because it explains to them whether their borrowers are collecting money basically within a reasonable time. Clear? So an increase in the period, clear, if there is a continuously increase in the period, basically it will result in greater blockage of funds in the debtors. Clear? An increase in the period will result in greater blockage of funds. Clear? Basically will result in greater blockage of funds basically in the debtors. So the ratio may be calculated by any of the following methods. Clear? So an increase in the period. Clear? Like we can say that basically if there is a continuously increase in the period, so basically funds are blocked basically for a long time. Clear? So basically will result in greater blockage of funds basically in the debtors. Clear? So the ratio may be calculated by any of the following methods. Clear? First one, that is months or days in a year upon debtors turnover. Second, that is average account receivables into months or days in a year upon credit sales for the year. Clear? Just basically they have changed debtors turnover. Clear? Debtors turnover, just they have put the formula. Debtors turnover, it is equal to what? Debtors turnover, it is equal to what? That is credit sales upon average account receivables. Just put the formula here, that is credit sales for the year upon average account receivables. Clear? Formula is to be same here. Okay, third one, accounts receivable. Accounts receivable upon average monthly or daily, that is credit sales. Clear? Average monthly or daily, that is credit sales. Clear? Just they have changed the formula. Clear? Just they have changed that formula. Clear? Just basically they are changing the formula, or basically we can say that rotating the formulas. Clear? In one and the other way. Clear? Basically in one and the other way, and you are able to get the thing. Clear? You are able to get the thing. Clear? So this is the formula basically for the debt collection period ratio. Clear? This is the formula basically for the debt collection period ratio. Hope all of you are now able to understand how this formula is to be formed. Clear? Now let's discuss significance. What is the significance of that? Clear? What is the significance of that? One question basically from these two ratios also, because these are very, very important for the examination point of view. So now let's start our discussion on that. So debtors collection period basically measures the quality of the debtors. Clear? So what it measures, basically it measures the quality of the debtors, since it measures the rapidity or slowness. Clear? Basically either basically we are receiving the money on time or slowness. Clear? Because it measures the rapidity or slowness with which money is collected from them. Clear? Because it measures the rapidity or slowness basically with which money is collected from them. A shorter collection period. Clear? Basically a shorter collection period employs prompt payment by the debtors. Clear? It reduces the chances of bad debts. Clear? Basically it also reduces the chances of bad debts. Clear? Like basically if we know that basically our account is in the category of SMA 0. Clear? So basically it's our duty, basically that is basically we have to follow up on that. Clear? That is it's our duty. That is basically we have to follow up on that, so that basically we are able to receive the money on time. Clear? Before the account getting NPA. Clear? Even if we know that basically if the person is any problem, or if the person has intentionally not able to pay the money, so basically we will also get before the time. Clear? So that basically we can use other ways to recover the money. Clear? So that is the same thing they are saying there. So a shorter collection period basically implies prompt payment by the debtors. It reduces the chances of bad debts. And on the other hand, basically a longer collection period implies too liberal and inefficient credit collection performance. Clear? Longer collection period basically implies too liberal and inefficient credit collection performance. However, in order to measure a firm's credit, clear? However, in order to measure a firm's credit and collection efficiency, its average collection period basically should be compared basically with the average of the industry. Clear? Like basically journal with the average of the industry. Clear? Its average collection period basically will be compared, or should be compared basically with the average of the industry. It should neither be too liberal nor to be restrictive. A restrictive policy basically will result in lower sales, which will reduce the profit. Clear? Basically, if we say that basically we will take all the documents every time. Clear? So basically it leads to basically we can say that basically, or basically we will give you or sell the products only on the cash. Clear? So basically it leads to the reduce our business. Clear? And not be like liberal, like basically you will give payment basically after 1 year or after 1 year. In that way, not also. Clear? So basically we have to follow not too strict, not too liberal. Clear? So it is difficult to provide a standard collection period basically for the debtors. It depends upon case to case. Clear? It depends upon the nature of the industry, seasonal character of the business, and credit policy of the firms. Clear? And credit policies of the firms. Clear? So it depends upon the nature of the industry, seasonal character of the business, and credit policies of the firm. Clear? And credit policies of the firm. Clear? So in general, the amount of receivables, clear, in general, basically the amount of receivables should not exceed 3 to 4 months credit sales. Clear? That is basically if we are sales our material. So basically we have to receive the amount basically within 3 to 4 months. Clear? So basically we have to receive the amount basically within 3 to 4 months. So this is the significance of the debtors collection period ratio. Please tell fast up to this much point. It is clear to all of you or not? Please respond fast up to this much point. What we have discussed question in the starting of the session along with that. So in this session, basically we have to discuss up to this much point. And one more session basically I will take on that, in which we will discuss some of other ratios. Clear? Which we left, like what is long-term solvency ratios. Clear? What all these things basically we have discussed just for the understanding purpose, or basically some important points I will discuss in the next session, along with 2 to 3 more numericals. Clear? So that basically you are able to understand all these points properly and able to answer the question in the examination. Clear? So thanks to all of you for joining this session.